Can UiPath regain the investors' trust after laying off 5% of his workforce and planning to lay off even more people in the near future? Today, I'm showing what financial metric will turn negative for the first time in company's history, what crucial KPI sits at an all-time low, and what major transformation happened to the cost of acquiring customers. Lastly, I will look at the true intrinsic value of the stock based on what management promised for 2023 and beyond. The best place to see all these is in the financials, and I'll start with the most important aspect, the revenue growth. UiPath grew its revenue 19% in the third quarter, above what analysts estimated, but unfortunately the guidance for the fourth quarter is negative 4%.
We are reducing our near-term forecast to account for a significant FX headwind, the macro environment, and our internal repositioning.
UiPath reduced its workforce 5% in June and at the end of October announced further restructuring actions that aim to increase execution velocity and efficiency. One thing that I truly like is that from a geographic perspective, UiPath's revenue is spread all around the globe, with only 25% of customers being based in the Americas. However, the downside of the geographic spread is that the foreign exchange pressure will continue for the next quarters. In terms of growth, Americas grew the fastest in 2022, followed by EMEA. Next, looking at margins, gross margin is the most important. UiPath continues to have one of the better gross margins in the software space, which proves great operating leverage. The operating margin was a crucial aspect of the third quarter's results. In the earnings report for the second quarter, UiPath promised us that
we are committed to our goal of achieving non-GAAP profitability and positive adjusted free cash flow in fiscal year 2020.
We saw a significant increase in the adjusted operating margin, which grew from negative 5% to 7% and is expected to hit 13% in the fourth quarter. Even if the adjusted operating margin completely ignores the impact of stock-based compensation, it is the first step towards achieving adjusted operating profit on a consistent basis. As many other software companies, sales and marketing is by far the biggest spending area. This shows that the company is spending massively into landing more deals and upselling its existing customers. However, to understand if UiPath is using its sales and marketing teams wisely, we need to look at the customer acquisition cost. It shows how much is spent on sales and marketing for $1 attracted in contracted value. UiPath improved its customer acquisition cost, which decreased from $6 to around $2.4. This is an encouraging sign, as the company managed to attract enough new business to justify the high sales and marketing spending. The free cash flow is a crucial metric for software companies, especially in this harsh macroeconomic environment. Given the company's growth profile, UiPath has only achieved free cash flow sporadically. Moreover, the free cash flow as percentage of revenue was at an all-time low throughout 2022, which shows that last year UiPath burned more cash than usual. We need to look at the operating KPIs because they can tell us in advance if a company is executing well. To keep expenses in check, UiPath's management follows closely a software operating KPI called the Rule of 40. It tells us how fast can a company grow without burning too much cash. Unfortunately, UiPath's Rule of 40 is close to an all-time low of only 7%. This shows that in spite of revenue growth slowing, the company's free cash flow margin isn't improving. I will closely watch the Rule of 40 as I want to see an improvement in this crucial operating KPI. Next, we need to look at another crucial KPI, which is the number of enterprise customers. At the end of the third quarter, UiPath had around 10,650 customers. Most of UiPath's customers, seen in the bottom left corner, have a small number of employees and a low ARR spending on the platform. Because of its go-to-market strategy, the best way to have a clear vision of the customer segmentation is to look at the ratio between enterprise customers and the total number of customers. At the end of the third quarter, enterprise customers represented 16%, while customers with more than $1 million in annual recurring revenue represented almost 2%. This is a healthy trend that shows that UiPath is persuading more customers to increase the spending on its platform. Another important metric is the net retention rate. This shows how much do customers like the platform, and it's calculated as the expansion of the annual recurring revenue for existing customers over the last 12 months. Even if it's decreasing, the net retention rate remains above 120%, which is generally a great value for a software company. But since the net retention rate is more of a backwards looking metric, let's analyze the future demand by looking at the remaining performance obligation. It consists of amounts that have not yet been recognized as revenue and offers a good image about the future prospects. The RPO grew because billed revenue grew, and this is a positive sign as future demand seems to be ramping up in spite of the headwinds mentioned. RPO is one of the metrics that I'm gonna watch closely to see if UiPath can get its momentum back. Next, we need to look at the bear case, which is constructed mostly around a slowdown in demand. UiPath guided for only 18% revenue growth for full year 2023, without including the 5% impact from the transition to a full subscription platform. Still, the 23% revenue growth isn't great for a company that spends around 60% of its revenue on sales and marketing. Other reasons for which UiPath stock might underperform are an imminent recession that will make customers postpone the automation spending, as well as intense competition from much bigger players. In terms of valuation, the last time I analyzed UiPath, it was trading around 8.2 times enterprise value divided by the next 12 months revenue, while now it is close to 6 times. Moreover, I've also done a complete valuation of UiPath stock that you can find right here. Utilizing the most accurate method to value a company, the discounted cash flows, and based on the management's guidance with very conservative estimates, UiPath is valued around $19 for the base case. This is based on a 2.5 perpetual free cash flow growth rate and a 7.5 terminal weighted average cost of capital. Moreover, using a terminal EBITDA multiple of 13.5, close to what Oracle is trading around, we get a price target around $18.5. However, since we find ourselves in a difficult to navigate market, please be aware that companies can remain below their intrinsic value for longer periods of time. Moreover, the market can overswing in both bullish and bearish directions, so it is always important to prioritize risk management. To sum up, I really like what UiPath has done so far. I believe it's incredible how much of the RPA market it had gained and how well it competes with Microsoft. But considering we're in a very volatile macro environment, which severely affects UiPath, I expect the stock to remain volatile, and personally, I don't believe that it's wise to open a position, especially after the stock had a 34% run-up. I believe that as long as the company continues to execute, better entry opportunities will arise. That's it from me. Until next time, keep crushing it and subscribe.